Welcome back to Markets Mindset. As we sit here just passing the second quarter and halfway through the year, I'm here with Moshe Tomkiewicz, head of Mizuho's DCM, and our special guest today, lead economist for Mizuho Securities USA, Steve Ricchiuto. Steve, welcome. Moshe and I, it's a pleasure for us both to have you here today. And I know you just came off a tour in Europe where I think you saw some 50 issuers of the firm and presented your views of the world and your prognostications going forward. And so we thought we'd have you on here so have our audience get a good insight as to what you're thinking. To set the table for you, $915 billion of IG corporate issuance so far year to date, record pace other than 2020, the COVID year. We're going to be our second fastest year to $1 trillion. And if we actually just do averages the rest of the way out, we're going to hit $1.5 trillion. And the market has handled it extraordinarily well. We're sitting at single-digit new issue premiums, 3 to 4 times oversubscriptions on transactions. Our attrition rates are 20% at most when we move price. And spreads have remained within a stone's throw of the post-Great Financial Crisis levels, or in the last 5-year levels of 86 on the index. We're sitting in the low 90s right now. And while things have weakened a little bit at the end of June, we still seem to be in great shape for the desire of the market to buy credit. So I'm going to turn over to Moshe for the first question, as he is a big Steve Ricchiuto groupie. Moshe, for Steve, what's one of the biggest topics your issuers are concerned about right now as we pass the mid-year point of 2024?
Steve, so I think the first thing issuers want to get a handle from you on is what's your latest mark-to-market on the state of the economy and what that means in terms of Fed policy. As you know, today we had the first negative monthly inflation print since 2020. So how's that gone into your calculus and what we should expect going forward?
The only thing to take away from today and the recent amount of data that we've gotten is the fact that the markets are pricing in a lot of rate reductions, and the markets are probably going to price in more. So I think that the situation is the degree of financial accommodation that's taking place is assuring the fact that we're not going to have any credit-related problems to deal with from a real credit problem. We're going to have sort of a credit spread issue if things don't go the way we want in terms of equity markets. But I think the real dominant issue here is the fact that the financial markets are discounting a lot, and we're going to discount more. I believe the market is going to push us towards the 4% level on 10-year notes. And I think once the Fed does, because they really want to cut rates, once they eventually cut rates, I think the forward structure of rates drops the front end again and reluctantly pulls the 10-year through the 4% level. When that happens, I think it's the bottom of the equation for the decline in long-term rates.
So have you changed your year-end rate at this moment, given today's, or you're waiting for more data to see?
No, we haven't changed our year-end number on the 10-year note. We're still a long distance away from it, and we do believe that the acceleration in accommodation in the financial markets is going to have a positive effect on the economy as we head into the end of the year. And I think there could be a significant reversal in the way the market is looking at the Fed and how much they expect out of the Fed going forward. And I think that could result in a powerful snapback at long-term rates before the end of the year, especially if the Fed moves earlier rather than later in the year. So if the Fed were to do something, I think, incorrectly and move in July, then I think you would have a very powerful rally at the front end of the curve. People would wonder what the Fed knows that they don't know. The market would get all bulled up. Yields would drop aggressively. And I think we would see a powerful rebound in the economy and a quick reversal in markets. On the other hand, if the Fed continues this game of suggesting September, I still think that the market is going to overreact, but overreact less. And therefore, the possible decline in long-term rates below the 4% level is somewhat more limited. And once we get below 4% is when I'd be looking to begin thinking about how do I lock in rates at these levels for the amount of corporate issuance, as you talked about in your preliminary discussion, that needs to come down the pipeline. And I think given where spreads are and given where rates are likely to go in the near term, I'd start looking for ways how I lock that level of rates in.
One of the big things that we've been all focusing on the capital market side is just the amount of liquidity that's in the front end of the curve. The last time I checked, it was over $6 trillion. Is the market going to look at the data today and the dovish Fed rhetoric, and to your point, in terms of the discounting mechanism, think rates are going to go lower and lower and start deploying that money out of the front end into term market for Victor denied market or in the equity market?
The reality is duration is going to get more expensive. And I think because duration gets more expensive when fundamentally you've got a healthy economy. Credit spreads are very, very tight. No one's worried about credit risk. No one's really worried about default risk. The equity market is setting new highs all the time. The yields on the 10-year note have come down almost 100 basis points. When you're looking at all the metrics that suggest to you how much is priced in versus how much further we could go, I think the real risk is the market gets ahead of itself. And that's why I want to use this as an opportunity as an investor to reduce duration, as an issuer to sell duration into a market that seems to have an insatiable appetite for it.
You mentioned before that it's a credit spread issue, but at the same time, you just said people aren't really worried about spreads. Should they be?
Well, they don't have to worry about spread from the traditional credit metrics point of view. Companies aren't leveraged heavily. They aren't leveraged short. They don't really have significantly rising debt burdens or debt burdens that would pose a problem for them. The question you get to is whether or not the equity market premium that's discounted into spreads, whether that will stay with us. If you have a significant reversal in interest rates before the end of the year, you could wind up seeing that portion of the credit spread argument disappear. And that could push out credit spreads simply from an equity perspective.
Talk to me about tail risk, because one of the things that we've been spending a lot of time with our clients is seeing how tail risks are getting bigger and bigger. Call it geopolitical, call it private credit. There's issues to point to. How do you look at that, and how does that fit into your outlook for the Fed and the economy?
Well, the geopolitical issues are always something that can exaggerate the downward movement in rates and eventually, therefore, exaggerate the rebound that takes place as well. The credit risk issues that people talk to all the time about regional banks or private credit or shadow bank-related concerns. I mean, it was indicated before that, there's $6 trillion sitting around in money market mutual funds. The reality, a lot of that money that's sitting in money market mutual funds is actually reserves that these shadow banks and private equity are holding. A lot of these people are graduates of GECC. They're graduates of the subprime crisis. They realize that you can't build a shadow bank that doesn't have capital and doesn't have reserves against possible losses. And the place where they hold those reserves and where they hold that excess capital is really in the money market mutual fund area, because they buy treasury-only funds. They're effectively guaranteed. They're highly liquid. Even in an illiquid environment, the Fed comes up with its programs that allow, which actually haven't gone away, which allow money market mutual funds to stay highly liquid. And the net result is it's the safest place they can put their reserves. And I think they have a lot more than markets think.
Switching gears just a little bit. We had an epic first quarter, and we've continued to have some pretty good supply. But a lot of, I will say, competitors away from us have touted lessening supply, more moderate numbers. Now, I do think things are going to moderate compared to the first quarter, but they're going to be robust, I think, in the next 2 weeks in between our inflation number this morning and the Fed. I think there's going to be a window in August when people don't want to get tangled in the normal rush in September. But it feels like for the next 3 months, we can have a pretty good pace of issuance. And a lot of it is being driven by people. We get asked the same question every meeting. Volatility around the election. What's the volatility like around the election? What can the election change going forward?
Government spending is going to go up no matter who is elected president. There is nobody on Capitol Hill who even discusses fiscal responsibility. That's number one. The pace at which we deteriorate the budget from $2 trillion is up for discussion. Joe Biden's program, if he were to have unified government, or even if he just had the House of Representatives, is more likely to be a bigger program than is the Donald Trump program. However, Donald Trump is more likely to look at cutting additional taxes. So the net impact on the overall economy is a healthier economy in a tight labor market environment already that leads to higher inflation. Either one of these produces that environment. The speed is greater under Joe Biden than under Donald Trump. But as of the election itself, volatility around that election for 2 weeks is going to be very, very volatile, especially if you have a unified government. Or if you have a Democrat in the White House and a Democratic-controlled House of Representatives. If you have a Republican in the White House and you have a Democratic-controlled House of Representatives, probably less so in the 2 to 3 week period.
Given your view on rates, right, given your view on the economy, and given your outlook on risk assets, if we're advising our clients and say our clients have a funding need 6 to 12 months out from now, say out the curve 10 or 30 years, what would you be telling them to do in terms of timing?
Yeah, I mean, I'd be telling them that what they're supposed to be doing is looking for an opportunity to lock in rates. That doesn't necessarily mean you bring the paper to market today, but you have to look at this rally as an opportunity to sell duration while people still want to buy it, and still want to buy it on yield, and still want to buy it on the belief that we're going back to that new normal period. I don't think that window will last very long, but it's not going to be terribly short either. So I think people have the luxury of assessing the situation, seeing how we move in the marketplace, how quickly we break through 4%. Does 4% prove to be as difficult as 420 was, or do we go through it like butter?
If we go through it like butter, there may be something else going on besides just a slip.
Well, I think that will be an environment in which you're sitting here and people are getting very, very bulled up about something else happening. People often speculate on credit disasters where there is no fundamental for it. To have a real systemic credit crunch, you need to have an asset liability mismatch and a bubble. I don't see any bubble. You can argue that some assets are expensive, but nobody's in a bubble. And there's clearly no asset liability mismatch. So speculating on something bigger, I think, is the risk. And I think you should take advantage of that because there is no fundamentals for anything bigger than what's happening already in terms of a cyclical credit squeeze.
Steve, look, thank you for being here.
Pleasure.
Always an informative session with you. It's going to be very interesting next 6 months, so we're definitely going to have you back. So for everybody, thank you again for joining us here on Markets Mindset. We look to see you after the third quarter. Thank you.